My name is Yusuf Olaoluwa, and let me show you the blueprint for the taxation of the digital economy. First, I must introduce you to the concept of the digital economy. The digital economy is the leader of a disruptive revolution that is putting rigid companies out of business. It is a worldwide network of economic activities, commercial interactions, all enabled by ICT. Presently, the digital economy is valued at $3 trillion. That's how massive the digital economy is. And so why do we need to tax the digital economy? Simple. Because we cannot afford to not tax the digital economy. What we must realize is that there is no such thing as a separate digital economy, but rather, the economy itself has become digitalized. More importantly, we need money. The digital economy is a way to resource revenue for the federal government. So how do we tax the digital economy? My policy, ROPE, ROPE, redefinition of permanent establishment. Now, let's start with permanent establishment. Any meaningful contribution towards redefinition must first start with a close look at our laws. Under Section 13, subsection 2 of the Companies Income Tax Act, it is a requisite that to tax the profits of a non-resident company, it must have a fixed base in Nigeria. Similarly, in JGC versus FIRS, the Federal High Court ruled that unless a company has a fixed base in Nigeria, you cannot tax it. This principle is not only known to Nigeria. Under international law, it is known as permanent establishment. However, permanent establishment is problematic. The problem with permanent establishment is that things have changed. Before the economy got digitized, a company would definitely need to establish a physical presence to carry on business. Now the rules of the game have changed, and we must change with it. In India, for example, here's how they are tackling their fixed base principle. Under the Finance Bill 2018, they've redefined permanent establishment to include significant economic presence, which means that irrespective of whether or not there's a physical establishment, a company will be deemed to be taxed once it has significant economic presence. Ladies and gentlemen, even if there is no Facebook office in Ikeja, we can agree that Mark Zuckerberg's people have a significant economic presence in Nigeria, and they must be taxed. It is one thing to redefine, and it is another thing to find a framework that works within the Nigerian tax frame. This framework is the Digital Services Tax. The DST is the next way towards implementing taxation of the digital economy in Nigeria. The DST is simply a way to impose a 4% levy on the gross revenue of digital transactions with Nigeria. Under my policy, once a company is deemed to have significant economic presence, the DST will apply. And under my policy too, here are the criteria before a company is deemed to have significant economic presence. 1, if it exceeds 50 million naira in annual revenue gotten from digital transactions. 2, if it has a user base of over 250,000 people who access its digital services in Nigeria. And 3, if it has entered into more than 2,500 business contracts for digital services with Nigeria. The DST is the next step towards taxing the digital economy. Ladies and gentlemen, the DST is simply a way for our laws to stop playing police and thief with digitalization. Quite honestly, our laws are too slow, and the digital economy is too fast. Here is a summary of ROPE, redefinition of permanent establishment. So right now, the FRS has the ITAS. We suggest that they upgrade it and increase it to taxable goods and services, persons and companies. 2, we suggest an amendment of Section 13, subsection 2 of the Companies Income Tax Act. 3, we request we follow the money. No online transaction goes without being to the bank first. So follow the money through the banks. And 4th, the digital service tax. The digital service tax already has best practices in Italy, in France, in Hungary, and in the United Kingdom.
Anytime I listen to these young ones, I become more convinced that the future of Nigeria is bright. That was Yusuf Olaoluwa at the 5th edition of the National Tax Debate hosted by the University of Lagos Tax Club from the 19th to the 20th of September 2019. As you saw in the clip, Yusuf was already talking about significant economic presence before it became law in Nigeria. And that leads us to the feature on today's episode of Tax Matters, Significant Economic Presence, SEP. In the course of the program, you will be hearing about PE, permanent establishments, FB, fixed base, and of course, the new baby, significant economic presence. Pick a drink, cross your legs, and let's go on a journey into the world of taxation. My name is Chiamaka Ohauchi. Our pilot on this matter is Mr. Michael ANGO, Associate Director, Tax Advisory and Regulatory Services and Head of Abuja Office at Anderson Tax. Effective 3rd February 2020, the Company's Income Tax Significant Economic Presence Order 2020 was issued under the hand of the Honorable Federal Minister of Finance, Budget and National Planning. The order defines the concept of significant economic presence as it relates to the taxation of non-resident companies under the Companies Income Tax Act, CITA, as amended by the Finance Act 2019. Now to our guest, Mr. ANGO. Mr. ANGO, thank you for joining us on Tax Matters.
Thank you for having me.
The Honorable Federal Minister of Finance, Budget and National Planning recently issued the Companies Income Tax Act, that's CITA, Significant Economic Presence Order 2020. What is Significant Economic Presence all about?
Thank you for having me on Tax Matters. I think before delving into what significant economic presence means, we have to first understand what the basis for it is. So it's actually a concept for taxing companies that do not have physical presence within a particular jurisdiction. Previously, Nigeria had rules for taxing foreign companies under Section 13 of the CITA, which provided, four broad rules for taxing companies that do business in Nigeria, foreign companies. Essentially, for a foreign company to be taxed in Nigeria, it had to have a fixed base in Nigeria. It had to either do business through a connected party. It had to have a turnkey contract, or have a perpetual, a permanent base in Nigeria, i.e., a fixed base from which it perpetually did business. So these were the broad basis for taxing foreign companies in Nigeria prior to the Finance Act. Now, the Finance Act then introduced two major amendments with respect to the taxation of foreign companies. It introduced the taxation of companies that provide what we broadly would refer to as digital services, and then also companies that provide technical, management, consultancy, and professional services. So in determining, what portion of income of those companies will be taxable in Nigeria, the concept of significant economic presence was introduced. So essentially, it's an apportionment rule. A company that doesn't have presence in a jurisdiction is taxed based on what we now call significant economic presence. And there are different models for determining what significant economic presence means. Now, with respect to the order itself, like I said, the order derives from the amendments in the Finance Act that was introduced in January. So the Act now give the minister powers to determine what significant economic presence constitutes. And so it was acting in line with those powers provided to the Honorable Minister by the Finance Act that the order you referred to was introduced. And this order then spelled out what significant economic presence means.
So significant economic presence is different from fixed base that we are familiar with?
Absolutely. In fact, in law, we'll say that is the particular mischief that the issue of significant economic presence came to cure. So like I explained to you, prior to the amendment to the CITA by the Finance Act, you couldn't tax a foreign company in Nigeria except it had a physical presence, which could occur either, where it does business through an agent, where it undertakes a contract in Nigeria, where it has a turnkey contract and all of that. So those were the, broad rules under which you could tax a foreign company. And then that created the concept of a fixed base. Okay, so a fixed base means I'm doing business either directly or through an agent, and that agent, for the purposes of that particular transaction, creates a fixed base for me. But the world has moved on. The CITA was last amended in 2007. Between 2007 and now, it's 13 years. A lot of developments have happened in the world. We have all sorts of business transactions being concluded remotely. You and I can sit down today and transact business with people in far-flung areas of the world, in China, in Indonesia, Malaysia, wherever our business interests lie. And these businesses are not provided by physical means. They're provided by electronic means. If I purchase an item online and it gets delivered to me in Nigeria, value has transferred, I've transferred value to someone. But that person, for all intents and purposes, is not in Nigeria. And I would not have created a fixed base for that person. So that is the whole idea that the significant economic presence came to cure. So now, if you derive income from Nigeria, carrying out certain types of businesses, whether you're providing digital services to Nigerians, Nigerians are subscribing to your YouTube channels or subscribing to some platform through which you provide services to them, irrespective of the fact that you do not have a physical presence in Nigeria, you will be taxed. So to answer your question, yes, significant economic presence is very different from fixed base. It's the opposite of a fixed base in terms of taxing of profits or income derived from Nigeria.
So what about permanent establishment?
I would say that you can use the two terms interchangeably. Let me explain how it operates. So you have a foreign company that does business in Nigeria. Let's assume, perpetually does business in Nigeria through a third party. So that third party creates what you call a fixed base. And then that fixed base constitutes a permanent establishment. So they're interchangeable. Like I said, if you don't have physical presence previously in Nigeria, then you weren't taxed. But because you could have business presence through a third party. So let's assume a company that is in the US or in the UK has a representative office here. Maybe it could even be an individual who closes deals and transactions on their behalf. That creates a fixed base, and then we'll say that that person has created a permanent establishment for the non-resident company.
Which kinds or types of companies does the significant economic presence affect in Nigeria?
Broadly speaking, there are two categories of companies that are covered under this. The first category of companies are companies that provide any sort of electronic service to Nigerians. So whether it's streaming services, downloading of data and all whatnot, e-commerce, provision of goods and services online, and all of that, companies that sell services or goods to Nigerians online. So any form of digital service, i.e. electronic commerce and all whatnot, are covered. The second broad category is companies that provide technical, management, consultancy, and professional services to Nigerians. So if you ask a company, for example, in the UK to provide some consultancy for you in respect of, let's say, you're trying to put together a business in Nigeria and they provide some form of management support to you, you're running a healthcare facility and then you have someone in the UK or in the US providing some form of consultancy to you, all these companies are covered. But of course, to the extent that one, they have significant economic presence, and two, there's profits attributable to the transactions that they carry out in Nigeria. For the professional services, it could be anything. It could be someone who provides, like I said, service in any form of endeavor. Any technical or management or professional support. It could be a lawyer, it could be an architect, it could be an engineer, it could be any kind of support that is provided, as long as it's provided by someone who doesn't have physical presence in Nigeria and it meets the threshold in the law, then those companies are covered and they would be liable to pay taxes in Nigeria.
Now, talking about providing digital services, management, consultancies, trainings, and the likes, what other conditions or criteria could make these companies liable to tax in Nigeria?
First, you have to have a particular income threshold. And the income threshold that has been provided in the law is 25 million naira, which some commentators and professionals have said is quite low, but I think government in its wisdom has pegged that threshold, which is just about $70,000. So essentially, I think that threshold is quite low enough to capture every company that does business. For those providing digital services, if you use a Nigerian domain, if you have a www.ng website, then of course, you are covered, by the provisions. Also, if you have, there's an omnibus provision that says sustained and purposeful interaction with Nigerian customers. So whether you have a Nigerian website or not, then you are covered by that. For the technical services, there are just a few exceptions. For educational institutions, they're exempted. And that is important because, as you and I know, that the reality of COVID-19 now is that most people who are going to be schooling cannot go to physical, institutions, and they'll have to be schooling, online and all of that. Essentially, if you are providing things like educational, if you're private, educational training, educational institutions, they are exempted.
Okay. That being said, can you please elaborate on Section 13, subsection 2C of CITA and Section 13, subsection 2E of CITA?
For a moment, I thought you were giving me an exam question. Okay, I think those two sections are the operative sections. They're actually the sections that introduce this concept that we've been discussing. So like I explained to you previously, Section 13 of CITA just had about 3 or 4 bases for taxing foreign companies. So the amendments now introduce these 2C and 2E. And what it introduced, the first one is the one that introduced the issue of the digital companies. So like I said, any company that provides digital services, streaming, downloading, e-commerce, provision of services, goods, and all of that. Then the subsection E is the one that covered the technical, management, consultancy, and professional services. Like I said, these amendments were essentially to ensure that the Nigerian government is able to tap into the value that all these companies derive from Nigeria. Previously, like I said, companies could do business in Nigeria as long as there was no physical presence. Then we had no means of determining what they were earning and, of course, taxing it. I could make payments online for all sorts of services, have them, and I'll enjoy them in Nigeria. So those two amendments now said, okay, look, listen, significant transactions in billions of dollars are being made annually from Nigeria. Nigerians make payments to all sorts of service providers. So the Nigerian government feels that, these values are coming out from our economy, and so we should tax it. So I think in a nutshell, that's the philosophy behind the introduction of these two sections.
All right, thank you, sir. How is the relevant tax authorities, we guess in this case, the FRS, going to determine that a company meets this 25 million naira threshold?
Honestly, if I knew the answer to that question, I'd probably be a billionaire. But I'll answer you by saying that, there are some gaps. And one of the gaps that we have with respect to this whole issue of, determining thresholds is that there aren't any clear modalities. So, of course, as a professional, I know that there are several things that the tax authorities can do. You can impose an obligation on payment platforms to say that any payment that is going out of Nigeria, that is going to a particular destination of a particular company, then you place an obligation on the payment platform, whether it's our banks or any other payment service provider, to deduct the taxes thereof, and then provide a report to you that will give you an idea of what goes out. But I think that they still need to do some additional work, and that's one of the issues that people have highlighted with respect to even the issue of the threshold. Apart from the fact that it's a very low threshold, the fact is, how do you even begin to determine when a company meets the threshold? How do you know that a certain amount of payments or certain amount of payments have been made by Nigerian residents to a particular company in Indonesia, in China, in Brazil, and all whatnot. So there's still need for government to do some additional work. I think FIRS, the Ministry of Finance, need to then sit down and issue very clear, rules, and let's have a very clear framework that says, look, this is how we intend to do it. But again, like I said, there are various ways to do it. One way is to impose a withholding tax, mechanism, and say simply, look, any payment that goes out to a particular payment platform, then a withholding tax of 5 or 10% or whatever it is should be deducted. And then thereafter, you can mandate those companies, to file returns in Nigeria. And if they have credits, they can claim those credits. But that would be one way to do it. The other way to do it, but which, like I said, it might be difficult to say that every customer should then account for the maybe withholding tax or VAT on the transaction. But you and I know that that would be very difficult in terms of administration. To be cumbersome, you're talking of 10 million, 15 million, 20 million customers. But how do you then get all these people to deduct taxes on payments that they are making? So this is one area where government needs to do additional work. It's a good concept, but it still needs some thinking through, and then it still needs some elaboration so that people know exactly what they're required to do. The companies have clarity on what their obligations are, and then the customers also know what is expected of them.
Now, for you, what would you regard as the broad implications of the significant economic presence?
I can wear two caps here. The first cap is as a Nigerian citizen. Of course, anything that my government can do to increase the revenue profile of the country is welcome. We have revenue challenges, no doubt. Our main revenue earner, crude oil, has significantly gone down in terms of its pricing and, of course, even production and ability to sell. So anything that government will do to increase our revenue profile should be commended. But having said that, as a professional, as someone who is interested in ensuring that Nigeria also, is able to play a prominent role in the global economy, we then have to say that, look, there will be implications, and we hope that these implications have been thought through. So one of the things that we think is that these companies then are now going to sit down and ask themselves, is Nigeria a viable market for us? And do we want to continue transacting directly with Nigerians? Like I said, we have a very big market in Nigeria, but people also transact business for various reasons. So I think we need to be able to make these rules very clear to the companies. We need to be able to let them know that you're not being penalized, but we're just trying to get a fair portion of the value that you derive from our economy. There will also be political considerations. We've seen the United States retaliate against some European countries that imposed digital services tax on American companies. The American government has recently tried to frame it as, taxing of American companies, which may not be true, but that has happened. We've seen communication between the U.S. government and the OECD. The U.S. government asking the OECD to halt what it was doing in terms of the taxation of digital services provided by American companies. So the Nigerian government also needs to be ready. There may or may not be a pushback. If there's a pushback, we need to be able to articulate the basis for these things and engage in the diplomacy that will be required. Because the reality is that most of the companies that provide these services, in huge volumes are not. There are companies that are in Europe or in America or whatnot. So we need to be able to engage. For me, the approach is always better to have, a consensus approach, a consensus arrangement where people are able to agree certain, frameworks before you go into implementation. Government, again, like I mentioned, has to come out with clear implementation frameworks so that these companies know exactly what their obligations are, and then we are also able to tax them appropriately and get a fair value for our country.
Finally, sir, how would you advise affected companies or other company executives to prepare themselves for exposure to significant economic presence?
Of course, anytime a new tax rule comes out, companies are always advised to seek professional, support. Get your tax advisors, get your financial advisors to look at what these implications are. Again, these rules have been made. You have to comply with them, except there's a change or any changes. So my broad advice to any companies covered is to, first seek advice, understand how this, applies to you, understand what the implications are for your business, and then from there you can take a decision to determine how you want to continue to deal with the Nigerian market and all whatnot. But the reality is that these rules are going to be with us. They're just, it's a global development. It's not a Nigerian thing. Nigeria is not in isolation. These rules have been introduced in India, in Israel, in Malaysia, in France. A host of other countries have introduced similar rules, for taxing digital, services and all whatnot. At the end of the day, the most important thing is to ensure that, Nigerian market remains viable. Nigerians are able to receive the services they require, and when they make payments for those services, the Nigerian government is also able to derive value from those services in terms of tax payments and all whatnot. I think if that is achieved, then everybody will go home happy.
Yes, sir. Sure, it's a global development. Thank you very much, Mr. ANGO. Thank you for sharing your insights with us today.
Thank you for having me on. It's a pleasure.
Well, viewers, we do hope that once again we have been able to enlarge your coast and that you have become better enlightened about the taxation system in Nigeria. Stay clean, stay safe, and let's do this again next week. Bye for now.